Hi, welcome everyone. This is the Family Office panel. I'm Colin Wheaton from Boston Innovation Capital. I'm going to let everyone here introduce themselves and tell a little bit about both what their family office is, what their, for lack of a better word, focus is, niche, and what they may be looking for. I think one of the initial topics that we're going to talk about is more germane to some of the companies that are here, which is kind of earlier stage investing in life sciences, that being kind of in the seed and the A round. One of the things that I always like to talk about as kind of a preface to the panel is to kind of set expectations in the audience as to family offices in general, investing in early stage life sciences. Just some numbers. There's about 8,500 both single-family and multifamily offices in the United States alone. It's the fastest growing investor segment in the world, with even faster growth coming out of Asia, in fact. The split between single family and multifamily is roughly 60-40, with single being 60, 40 being multi. Multifamily's offices are generally more staffed, if you will, than single families. Single families tend not to be. I would say for that reason. The other thing too is average size has been increasing, with obviously billion-dollar family offices the fastest growing that we've seen in the last 2005, so 13 years. But the average assets is about 475 million. That's the average. So there's obviously some big ones. So it'll give you an idea of kind of where things are in terms of AUM. One of the things to think about is, why would a family office invest in early stage life sciences? Generally this group does. They wouldn't be here otherwise. But there's an awful lot of family offices, and I would say overwhelming majority does not do it as a matter of practice. They will do it generally as a one-off, usually because they know the jockey, whoever's running the company, some way. It is, and the reasoning is simple. It's math. You've got to deploy X amount of capital at a family office in order to make it worthwhile as an asset segment. And in order to do that, to do it efficiently, you've got to diversify at least 20 companies. And in order to do 20 investments, and in order to do that, you've got to have at least 2 to 3 people on the staff. And a lot of family offices just don't do that for a very small sleeve in their portfolio. It's not worth it for them. So with that great bit of news, I'll go forward and let people speak. But to set expectations, for instance, we have, LSN has a database, and in our family offices we speak to or reach out to hundreds, if not thousands, of family offices. But we probably have active family offices somewhere in the neighborhood of 50 to 70, and that's it. So you can imagine it's not as big a universe in emerging life sciences as people think it is. So with that said, I'm going to let everyone introduce themselves. I'm going to start with you, Sherry. We'll go on the other end.
Okay.
And then you can give a little bit of background about your family offices and kind of where you fit in all this.
Okay. My name is Sherry Grieswood, and I'm here as the Senior Investment Officer for Fox Hill Asset Management. We are probably at the far end of the spectrum of family offices that Colin has kind of described, and a little bit of an outlier compared to others here in the group for several reasons. The first is that this is a fairly new family office. It's been in existence about a year. And it's comprised of siblings who wish to do direct investments, so that is also contrary to a lot of family office modus operandi. And the reason is, as you might suspect, with many family offices, a certain amount of philanthropic aegis in that They've made money and they want to be able to give back. And healthcare is one of the areas where you can visibly and tangibly make a difference. So with that said, they decide to pool their resources. Most of the assets come from active alternative investment trading. So there is a different risk profile on one end of the spectrum of the siblings, and then on the other end they're more modest. My function has been to help guide what I'll call first-timers in this particular space to define a risk profile, since it varied between the people that are very actively in the market and those that are not, and try to put that risk profile in some kind of context with what's available in life sciences, and in particular, what might be available in opportunities that they feel they can be part of for a long period of time and really feel that they made a difference in. So we look at, I'll call it leading edge, niche, and very disease-specific kinds of opportunities on the therapeutic side. We will look at devices that are oriented towards supplanting the use of drugs or being used in such completely novel and new diagnostic fashion. And we will look at certain kinds of diagnostics. We are not really into digital IT per se, and we don't look at large diffuse markets such as diabetes or cardiovascular, where it's really hard to move the needle based on an individual or a set of individual opportunities. We like to feel that we can look at opportunities that can really truly influence the industry in some form or another. Examples of that might be nucleic acids and gene therapy, focus on some kinds of rare diseases, novel mechanisms of action. To go to Colin's other point, that when you work with a very small family office, it is really resource constrained, so I'm it. And they're fortunate, and I'm fortunate, I guess. I've had 30 years experience on Wall Street as an equity analyst and as an investment banker. Then I started out with a science background, and over that period of time, I'm pretty pithy at asking a lot of scientific questions, so I can get a lot of the basic due diligence done, and then if the company's not public, then we use other resources to help fill out the due diligence that would be necessary to do an investment. We really think that healthcare is going to be where technology was in the 1990s. We're on the verge of a huge advancement in medical knowledge, and so this is really an exciting area. And I think that might go to one of the other points that Colin made, is family offices have not been in this space for very long. As direct investors, they've been afraid of the FDA, they're afraid of the timeline, any number of things. It was easier to invest in the garage, start up on tech, and be $1 billion company. But now there's so much going on in medical science that is truly getting exciting, and I think it's that passion and excitement that begins to bring individuals into the market where they feel they can have a personal connection. And as with this family office and many, many others, there is some sort of personal connection a lot of times to the things they like to invest in. Thank you.
I'm Ron Paliwoda with the Paliwoda Group. We've been around since '95, so I'm not sure if we're old. I feel like a dinosaur in this particular area. So we have several funds in the office covering green technology, digital media, and of course the life sciences in our health tech fund. And that fund focuses on ways to reduce the cost of healthcare to consumers, not just to the hospitals. So things that drive down the cost all the way down to the individual consumer. The way that I like to express it is that I'm not interested in curing cancer. I'm interested in making cancer treatment more affordable to more patients. So we're kind of laser focused on that. The types of investments we look at include things like personalized medicine, genotype diagnostics, digital biomarkers, and more recently lab-on-a-chip technologies to reduce laboratory costs. So we've been working on that for quite a while now. We have internally both capital as well as internal expertise that we use for new types of investments. But to Collins' point, recently we have been approached by other family offices and also hedge funds, basically seeking our insight into some of their proposed investments. And in some cases, we give our stamp of approval. In other cases, I tell them to kind of run away from that particular investment. I think when you look for a family office that you want to approach, you really need to understand the depth of knowledge that they have and target your messaging to that depth of knowledge, because not all family offices are created equal.
I'm Kevin Schimmelfennig. I'm a managing partner at McGeever. We're a single-family office out of Raleigh, North Carolina. We're not quite as old as you, but we've been around since I think about 2004, 2002. Our focus is primarily healthcare, but I will tell you our portfolio is diverse and it's opportunistic. And what I mean by that is through relationships with other family offices, we own investment in an entertainment company. Never in my wildest dreams that I think we'd be involved with that, but it's actually kind of cool. However, it hasn't made us any money, so I'm not that enthusiastic again. But our primary is med device, specifically in the diagnostic and med device space. We don't look at life sciences as much. We like the idea of products that open up the door to start a line of revenue in the med device space. We have gotten disciplined at being undisciplined. And what I mean by that is we're not smart, right? We're not scientists. We don't have that capability. We have a staff of about 30 people, and boy, are we really good at telling you what we have to deliver into the market. Our belief is nothing matters till somebody sells something. And to that side of the market, we've actually built out. We'll invest in companies, bring commercialization efforts, and we even have a complete wholly owned subsidiary, it's a commercial arm, that will execute on a strategy. So we try to identify opportunistic situations where we can come in and leverage the heck out of someone's technology and take it to a higher level in the marketplace. Ironically, that opportunity is not just in the environment that we're here today. We're actually finding a complete contradiction. We're actually finding more opportunity in large corporations that are collapsing down on each other. And any business they have that's under $100 million is subject to liquidation. And we think that is a really cool place to go. If you're doing 40% margins on $100 million, we tend to think that's a really good place to be. They don't. So we try to do that. But what it's also done is it's given us the opportunity to engage with those partners, and we actually see what they're looking for. And so when we come to look at early stage opportunities, we're very myopic and sometimes very deliberate and strategic, so sometimes we'll engage and sometimes we don't. It does create a bandwidth on occasion issue, and I think Colin's spot on in that part. There's times we just can't engage with some of the early companies. We try to be polite and respectful, but it's daunting. Give you an example, coming into this conference, you get overwhelmed and trying to get all those emails back. It's not going to happen. I promise I'll respond in the next week or two. But the concept is, try to look at opportunities, see what fits, and we do that. Our active portfolios, probably got about 50 active direct investments. We also have limited partnerships in a couple private equity funds as well. We are also involved with NIH grants when they do commercialization. We actually look at companies for their ability to commercialize, which is a requirement now of some of those grants. And fundamentally, we've done both manufacturer deals, hospital system deals, insurance deals, GPO deals, as well as deals with the investor where we've co-partnered to help with commercialization efforts. So we like to think we look at the whole ecosystem of healthcare and try to understand that. There's a lot of interesting things going on in healthcare today, so we try to understand where the wave is going and try to participate with those types of companies.
Eugene Durnard from the Stetson Family Office. We're actually almost, I would say, a 99-year-old family office to be a 100-year-old. So I think it's more in the protozoa type of thing. We are actually extremely excited and passionate by healthcare, both from the philanthropic and the for-profit side. I completely, I'm with Sherry that we see this mega trend, very positive sort of upside spiral in the research and also in the reduction of computational costs that actually are directly influencing the all the progress right now that we're seeing in healthcare that is becoming much more of a predictive science. So we're very excited about that. We are actually longer, I would say, later stage investors on the investment side, and to also kind of corroborate what Ron is saying, we're in terms of sourcing and looking at deals and also co-investing with deals, we have been really putting together a network of other family offices who are not just interested but also have very deep professional expertise in healthcare, and there aren't that many of those, that's true. But in order to create very much of a 360 degrees view on specific sectors, because we think that there is an opportunity to play also a lot of the convergence between the sectors, and because we do not necessarily ourselves have an expertise in all of them, we're putting together relationships both with families on the co-invest side, but also families externally to in other countries for distribution opportunities. Because as you mentioned, Kevin, you know, the commercialization aspect is a must, you know, and if we are able to hold or participate in companies and help open markets to them, that for us is it's a win-win situation for everyone. So.
Good. One of the things I think that we wanted to talk a little bit about is the challenge for early stage companies in this space raising money. And my observation has been, we've been doing it now for a while, but not nearly as long as many on the panel, but I think there typically is an ebb and a flow in the cyclicality of it, and right now it seems pretty frenetic in terms of the amount of capital chasing deals and a lot of good deals. And I'd be really curious to what the panel may think in terms of what I'll call the kind of where we are in the cycle, or you know, kind of what their observations are with regard to both the quantity and the quality of early stage companies that are coming through the door. I heard this from one of the head of a corporate venture arm in town here, from a large pharma, and she was saying that she's never been busier, she's never said no more times than now, and she's never seen better companies. And it was kind of an interesting situation where, you know, at the margin you're seeing really good companies not getting any money, and that's really what she was saying. So I'd love to hear, Sherry, just any opinions on that. I mean, I don't want to, I'm not painting a negative picture, but I just want people to be real in terms of their expectations.
I think that the interesting implication of that observation you made really goes to what I have been telling young companies, is that the competition for capital is extreme. There's plenty of capital, but the process of decision-making around it has gotten longer, and because there's so many opportunities, many of them really good, it means that from your perspective as a relatively new entrant, you really do have to work harder to make sure your I's are dotted and your T's crossed, because you've got 2,000 other opportunities probably about equal merit to get in front of the eyes of somebody who's going to make the decision. From my perspective, both as an analyst and a banker, what I am seeing is a bifurcation of the industry, wherein 20 years ago maybe there was a typical path that young companies took. They did their Series A, Series B, there was perhaps an initial public offering, there was less professional money controlling the process to that public offering. We've evolved over the last 10 or 15 years, thanks to the financial crisis, with more concentration and control by large VCs in certain sectors, and other sectors being basically starved. And so this has made a valuation, the valuation question, which is a lot of reasons why investors say no, to get to be distended on one end, depending upon if you happen to be in the hot indication or a hot tech for that moment, versus other areas. A perfect example of that is obviously T-cell therapy and certain gene therapies where the private marketplace valuations are in the hundreds of millions, hundreds and hundreds of millions, and that wouldn't have been the case 20 years ago. That would have been spun out as a public company and would have been long gone. But the attraction of these mega valuations is holding the money closer to chest, which means that some of that asset money was not being redeployed, and the expectations for coming on are much higher because the investors are looking for a different level of quality and certain kinds of indications. I think that it's really difficult now if you are, you have to time when to hit investors with certain types of tech in order to get that valuation and interest, and hopefully be early enough so you don't have mega opportunities ahead of you that it already takes and raises the bar too high.
Can I chime in on that?
Yeah.
Valuation. I think that right now, a lot of interesting projects are just way overvalued. I think there's a level of expectations. Where did the money come from all of a sudden? Well, a lot of the money came out of Silicon Valley. People are pulling money out. They got to put it somewhere. There's no the next Facebook or Instagram or whatever the case used nowadays. Well, they got to put the money somewhere. So here's an opportunity for them to throw the money at it. But I think the level of expectation in terms of exits is a little bit unrealistic. This is a much longer game than an app for an iPhone kind of a business. So there might be some easy money now, but if you're doing a seed money, where's the money going to be when you're trying to do Series A or Series B? So you have to think about not just having money available now, but having an investor lined up that is going to stick with you through the trials and tribulations for Series A or Series B. Otherwise, you might not appreciate the response 2 or 3 years from now.
I guess I would just add similar comments. Two things. One is I think what's happened, there's so much deal flow coming in, and they're quality deals. You can throw just caveats out front. If it's this valuation or higher, we're not looking at it. And companies put themselves out of the market, to your point, where certain deals they just won't even look at because you're coming with the valuation, they're not looking at those deals. The other thing is you know, as I said earlier, nothing happens until somebody sells something. This is a lifelong sales cycle in your world. You are the #1 salesperson for your company. Your sole job is to get money. Forget about making the product and all that stuff. That's great. But your job is to have enough cash in the business to fund the company to continue to make that stuff as a CEO. And you're always raising money. The minute you finish a round, you start the next one. That's all that goes on. And what's scary right now is you have a collapse of the potential buyers. So if you're selling a big corporation, give you an example. We were talking to one company and we were very excited about them. They had made a couple acquisitions. It was perfect. And the phone came and we talked to them and they said, "You're not gonna believe this, but we got bought." And so that's happening. And then there's, the CEO involved. It's just fantastic at what he does. But there's no way in hell he could have predicted for that. I mean, no one saw the company, even the people working at the company. So making sure you've always got multiple things, irons in the fire, multiple sources for money, and multiple outcomes is really critical. And then try to line up with your investors. There's a comment made about family offices tied to disease states, and I didn't reference that, but we do that as well. In our family, there's been certain disease issues, and that becomes a prominent discussion. That puts a deal into our bucket, but we don't publicize that, so that might get a deal through that doesn't fit other criteria. But make sure you know how those families' offices are investing, and look at those. The other thing I'll tell you is from a perspective of show up where they are by accident. If that makes sense. If you're a really good salesperson, you're there by design. So I'll give you a quick example. There's a specific company we're trying to buy a product line from. Across the street is the healthcare conference for Wells Fargo. Their CEOs are all talking. Well, I made sure I was in the back room as they're walking off the stage, right? That was not by accident. He may think it was, right? That's the stuff you need to do, and you need to get really comfortable doing that. And, the comment is get comfortable being uncomfortable.
I'm actually going to take a slightly contrarian view on the valuation. We find that there are some opportunities outside of the U.S. and even outside of, let's say, Cambridge here, or Boston, and Silicon Valley that actually have, I would say probably reasonable valuations. I think that, especially if you go to Europe, the general provision of venture capital is lower there, and so the valuations are directly proportional to the amount of essentially risk capital available, and because there are actually barriers that maybe at some point will go away, but people don't have access to for example, people in Europe do not have necessarily the same access to the capital here in New York and in Boston than people in Boston, right? So that creates, we actually find that there is, yes, I agree with you that a lot of the market is pretty high and also on the public side, but I think it's a matter of looking a little bit outside of those two centers. Yeah.
Great. I think what I wanted to do right now is just take a breather. Any questions? Let's talk to our panelists here. Does anyone have any specific questions with regard to approach of family offices and how they operate? Yes?
Sure.
Go ahead.
For family offices, what do you find is the best approach? Introduction from another family office, introduction from a friend, introduction from
In my experience, if you get a referral from one family office to another, you can't get much better than that.
Okay.
Or I will say this too, one of their portfolios. That to me is the best. I mean, but not all people have that, so therefore, how do you do it? Again, I think it's kind of what Kevin said. You got to be both aggressive and you got to be patient and respectful, and all in the same way. And that's hard. And I get it. So you just try to be, it's marketing 101. Try to get someone's eyes. I mean, the folks in this panel and every investor, I mean, you have such limited bandwidth and attention to detail when people send emails, and I'm sure you guys have all heard this, and phone calls. It's like, got to get them in the first 10, 15, 20 seconds to get their interest.
If I could just follow up on that. What does no mean? If I tell you I'm not interested right now, focus on the right now piece, not the no piece. Because what's happening is that I only have 25 hours in the day, right? So I only have limited bandwidth. And I might be chasing a certain notion at this particular moment. But if you're in my ecosystem, on my radar somewhere, we have an office, folks that keep track of projects. I might 5, 6, 7 months from now remember you and reach out to you, and I have no problem picking up the phone and calling people. It's 5 o'clock in the morning, no problem. But so once you get in front of any investor, okay, stay on their ecosystem, stay on email updates, and just don't polite email updates, don't stalk them, please. Because you never know. Because I might remember your project, or I remember you personally. I always have problems I need to find solutions to. And if I remember that you provide a certain solution that might fit, then there you go. Okay, I've seen many. I think we have hubs here now. So they're early entrepreneurs, naive entrepreneurs, I would call them. And I would encourage those young entrepreneurs to remember that it's not the current project that you need to market. It's the next project that you have in your head. Okay, so stay on their radar. So whatever you're doing right now may or may not work, but there's always going to be the next itch you're going to have to scratch. And rather than starting from point zero all of a sudden, you might as well maintain that relationship with that individual. And it's not the office, it's individuals within the office. Okay? And that'll really get you in the front door maybe the next time. Okay, so it's a longer-term relationship that you need to focus on.
If I can just reiterate and add a little more color to Ron's comments, because they're actually right on. I tell companies it's part of getting to know what you're doing is understanding the right investor at the right time. And businesses go through cycles of maturation from the entrepreneur who originates the idea through the tech transfer to the early financing to moving up management changes. So there is a life cycle to the company, and each part of that life cycle is predominantly best funded by investors who know that portion of the life cycle and comfortable with it. And to go to Ron's point, staying in touch is really the key to that for two reasons. One is, and this doesn't matter whether you're private or public, you want to demonstrate that you are achieving milestones, you're executing on your plan. And if you drop off the radar screen and you really are, you're missing an opportunity to come back in touch with somebody who may be the right investor at the right time. To just give you a generic case in point in this, 3 years ago I saw a company that was based up in this area with a very unique product to deal with something that was going to quantify on a diagnostic basis a system of diagnosis that was always done on patient-reported outcomes. And the technology was geared to animals, and I said, well, this is great technology, let me know if I get commercialized. Because I really believe that we need to have a quantitative identification of pain and pain level. And interestingly enough, I met with a company today and I said, gee, I remember this technology from 3 years ago. Oh yes, we're merging with that. So that got my attention right away. And it's really important, as Ron said, we all have multiple ways we look at things. It's not just the direct investment in a serial process, but there are other connections that can be made that may be fortuitous and helpful in a collaborative point of view, or it may be that you're just at the right stage for that investor at the right time. And it's like you say, it's not about the no, it's about you're not right for us for right now, but, and that's really the important message to take away when you hear a no.
You had a question?
Yes, please. In terms of your investment thesis, balance between singular company investments versus maybe acting as an LP into a fund or into a portfolio of opportunity?
So we do both. It depends. So we have a couple partnerships we're in because we know those are usually entrepreneurs that do really well, and now they decide to manage the sector. So we have a couple in very specific. I'll give you an example. Carlisle is not going to take our call, but we're in Carlisle. Through de facto, we may only be a sliver, but the fact is we're in there and doing very well with them. So thank you very much. We're willing to pay a fee for that. We get more direct when we see the ability to go and help a company advance. So if there's things we can do, there's kind of bringing money and bringing smart money and bringing productive money. If there's something they're doing and we know there's a contact where we can pick up the phone and connect some dots and short circuit. We're very fortunate we have a great network in corporate America. I could pick up the phone and call XYZ senior executive or CEO and say, we have a technology. I think you ought to take, some of your business development folks, and I'll take a look at this thing. Doesn't always work, but a lot of times they'll take a quick look, and hopefully short circuit the exhaustion of that CEO who's working really hard, and either eliminate something quickly or calibrate what needs to be communicated and when, and tee them up. And we try to do that as well. So I don't know if that addresses your question, but we kind of do a little bit of both.
Thank you.
Just wondering how you calibrate whether valuations of a private company, early stage life science company, no revenues, no earnings, how do you calibrate whether it's high, low, or just right?
Valuation is an art form. Okay, there's no spreadsheet. Okay, the way I look at an investment opportunity is, what have you done so far to justify me investing in your project? In life sciences, it's very easy to run an experiment. You see the results, on the basis of that result, you make a decision. Previously, I've seen projects where they actually took it out, tested it clinically, brought it back, and said, okay, these are the results. Now, I see a much earlier attempt at requesting an investment. To me, it's a little Wild West at this point. My recommendation is if you're going to approach a smart investor, have your ducks in order to justify the solution, to justify the valuation that you're attempting to assign to that solution. Right now, there's a lot of hand-waving and hopeful.
The best thing, if I can just add on that, the best thing you can do is look for proxies. And this we do in doing equity analysis all the time. If you can't find a specific measure to measure that company's valuation, find the company that's closest that you can find, for which you can get some statistics or numbers around, or look for other companies that are private that you know have gotten financing. And you'd be surprised if you're willing to dig around the internet enough. You can sometimes come up with enough data points that when you do your presentation to an investor and you think the valuation should be in this range, you can say, here's a public company that's kind of like what we did. They went down this path. There's their market value. Here's a couple of other transactions that occurred. And that at least gives the investor a footing for which to have the conversation. But at the end of the day, it's a negotiation.
Yeah, I was just going to, I'm sorry, go ahead.
See, I don't rely on comps at all. I think they're, sorry.
That's okay.
Okay. I think I don't rely on other fools' decision making. Not that doesn't sound right.
For the company to support its position, that's what I was saying.
Well,
whether you accept it or not, it's different.
No. It's I think that the valuation might be you might be paying up for a certain team. Okay, you might be paying up for many other factors other than the science itself. Okay, I've seen people overbidding simply because they want to take out a company off the market. There's a lot of egos going on here. Okay, so those are some goofy outliers that we really don't play around with. We do our own internal assessment based on the science and based on the science of the market opportunity. And if you're coming to me without any data, I can't help.
I just kind of make sure you know if you're in a negotiation. I think that's probably the biggest issue because, depending on the time we show up, investors of capital will put the work. I disagree. I think you do have some comps out there, but the comps aren't it's not like buying houses in the same neighborhood. I think the comps are along the lines of, I have an entrepreneur that shows up and has a valuation of $10 million and they have no IP. They just started. They, at best, don't even have anything tied to a proper name that it communicates what they do. So you have those types of issues when I think about comps. Think about companies that got funding. Do they have certain criteria? And do you have some of those things in place? That's probably the biggest thing we'll see is companies that just aren't prepared for an investor. And I was on a panel not too long ago, and one of the investors said, don't show me another convertible note. He said, that's basically a cop-out that you don't know what your company's worth, but yet the investor is going to pay for you to go build valuation for a discount down the road. So if you ever do one of those, make sure it's capped from an investor perspective. But so I think the issue is along the lines of making sure you've got your ducks in a row of what items you're saying to justify what you're asking for. And before you get too involved in it, ask them if they have the cash to put in if you do get a good valuation. Because you could be haggling with someone that has no intentions of doing it. I've seen many people in the industry say, give me your information. They own the other company. And you're free market research. So those are the things we'll
We in very specific sort of situations, we try to, lots of situations, trying to actually stage the investment in function of success of the usage of capital, in the sense that it's not a matter of whatever the valuation is decided on. Also, it's not just about the valuation. It's how do you don't necessarily pay for it all in one chunk.
Yeah, you tranche it.
You tranche it,
Yeah,
and that's
absolutely.
I think is a pretty important aspect, even sometimes more so than what.
I think that's getting actually more common as these valuations are getting more wacky. That's just what I'm seeing. Yes, sir.
Well, and you mentioned a while ago Marketing 101. one aspect of 101, of course, is identifying your target audience.
Yep.
And one of the frustration I have, and I think it's shared in large part, is identifying family offices, given there's a lot of them, and it's growing, given that there's often strong affinities in the family for a certain thing, for a certain solution. That rings a big bell, as far as I'm concerned. And yet, it seems like an endless sea of... so is there any way of getting a little better handle on who's in the space? It's a good association.
This is a great question, and it goes on forever. I mean, it's the classic example. We've been talking about this kind of round and round. It's an investor group that doesn't want to be found. It's an investor group that doesn't want to be solicited by what I'll call mainstream banks, etc. Yet they want deal flow. I mean, it's really difficult. I mean, I don't know that there's a solution. There is a business to be had to do this, for sure. And it's possible family offices get more formal with regard to some of these groups. There are a lot of, Tiger 21, CCC Alliance, there's a lot of these networks, family office networks out there, but it's hard. I mean, there isn't an answer to answer your question. I wish there was. I would have known about it, believe me, by now.
I would just give you an analogy. It's much like healthcare. I've seen one healthcare network. I've seen one. You can't have the same strategy to sell the Cleveland Clinic as you can UPMC. So unfortunately, folks, it's hard. If you want it, you got to work for it. You got to figure it out. It's not fun. But I would go back to the comment that was made by someone. If there's a way to get into that through an introduction, you'd be shocked at how much time we spend talking to each other over anything else. I mean, I'll eliminate calls because, like I had one yesterday. I had a very successful real estate family out of Florida. They're looking at a healthcare opportunity. They sent me the deal right before Labor Day. Said, hey, would you mind looking at, we don't know healthcare, and we had a lengthy conversation. I had nothing to do with the deal. If they offered for me to participate, I probably would. We've got to do more due diligence to the deal, but there's an example of that person has no idea I looked at their deal. And if they called me directly, I wouldn't have taken the call. So again, I don't mean to sound aloof. That's not my intention. It's just honestly, you got to work a little hard. Look at what's in the portfolio if you can find out. I encourage you, there's a couple, there's more news feeds than you can handle. So if you find there's a couple good ones, it's escaped me at the moment, but one of them says what companies got funded and who funded them.
Crunchbase.
Thank you, that's one of them. But you can go ahead and just follow that and work your way back. Call the CEO of that company, because if nothing, they'll have compassion, because they were the same damn spot you were. And if they don't, they're jerks and probably not going to get much further. So I would encourage you to leverage that if you can.
Yeah, and I'd say one other thing too is if you know someone at family offices, you can start anywhere. Ask them if they know anyone and try to get some more leads, because I started working in the family office space 14 years ago when there weren't that many, and it was it's all word of mouth. Who do you know? Who do you know? Who do you know?
If I could add, the one thing that just came to my mind as you said that, Colin, was LinkedIn is kind of interesting.
Yeah.
So if you can LinkedIn and then just connect with the viable reason and not try to sell them. Like I've got LinkedIn requests where you can't fit any more space. Thank God LinkedIn stops them. and ask me for money. I mean, literally, can you write me a check? Versus someone who says, hey, I see what you invest in. I'd like to chat with you if you get a chance. Okay, maybe when I get free time, which I don't have very often. But someone who says, hey, I see you're investing in this company. Is there a chance we can talk about that? It's a thoughtful message. But they took the time and looked up and they saw things we had and they connected some dots. And that's a good way to go. I mean, you just go and type family offices in LinkedIn, you might find something. More importantly, I think LinkedIn will show you in your network anyone that's in that somehow ties. And before you go direct, try to go roundabout and see if you can get in. So that seems to be a productive tool. Not that I don't know anything on
And just a couple other ideas for those who don't want to get LinkedIn to get in everybody else's network, because some of us do like to keep a low profile. Some states do have registries of family office, like New York State. So you can glean some information sometimes off of those state filings. Another way is many of the larger major networks actually will do syndications with certain family offices, and that's usually a very good way to get in that personal introduction kind of thing. You can be part of an angel network or speak with an angel network, and They're wanting to help broaden their investment reach by syndicating with family offices, and it's a way of getting, and then, as been pointed out, pick a company that you know in the space and do a little digging on the internet. You might trip a couple of names and then you can do research on them.
Anyone else? Yes.
Is there any, and I'm sorry, this might be an ignorant question, but is there any pattern in what family offices are typically more interested in than compared to mainstream?
No. I mean, I don't think.
The only thing I can think of to share with you is understand what a family office is. So I can speak to a single family office. Our job is to make the family more money, period. It's to make sure the family has money to go on vacation. Right? Just that simple. So they invest in stuff that makes money. Now, they clearly get involved with philanthropic things. They do all those things as well. But at the end of the day, it's to make sure they're not worried about buying anything. And so the logic, we're in healthcare because we made our initial money in healthcare, so it's a space that fits well for us. But we are involved in real estate, all different things, and ironically, those are coming from other family offices. So, I mean, just to give you a quick example, we're financing a building in Atlanta I'll never see. I don't need to look at the deal. I don't care what the building looks like. I'm not going to go in it. But the relationship and the way we did the math and the project, the people we're involved with, they're on the ground. Would I lead with that? No. But just like they're the same people that actually called me about the healthcare deal, that will take the lead in that if they do that. So I do think you just need to understand it's a perpetual anomaly.
Yes, sir.
Given the fact that you guys have limited bandwidth, is it fair to assume that you do not want to be a lead investor in the majority of the rounds? Or is that
I don't think that's necessarily the case at all. I think it depends family office to family office, and I think, and I'll just take one thing, is I think specifically the panel here are those family offices, and generally at this conference, that have an affinity and a specialty in this area, and frankly, I think they'll do as much work as anyone else at any other institution at anything you find. Now, there are certainly family offices that don't have the expertise, that may co-invest or be a syndicate partner if their friend at XYZ Ventures is leading the deal. Absolutely.
I concur. It's just define what lead means to you, right? So that's critical. Like I said just 2 seconds ago, if it was a real estate deal and I've got a family office I'm engaged with, they're much smarter. I'd rather be the follow. They step into a healthcare space, specifically one where we've already done a project and have networks and can pick up the phone and leverage. We'll lead. We tend to share information. Also, too, and someone referenced the Angel Network, we definitely have a lot of contacts in the Angel Network. And when deals show up on all over the country, that's an interesting note for us. We'll pick that up, that there's a deal floating east and west coast. We'll also pick up that if the deal doesn't sell at home, that's a concern. If you're from Boston and you're down in North Carolina, and we'll ask, Boston Harbor Angels look at this? And you say no, or they're not interested. Usually we'll say, well, let's think about it, and we have a phone call with those guys. And they'll tell us, here's the good, the bad, and the ugly, so to speak.
If you can add value through expertise and lead, and that benefits the project, then we'll do it. Otherwise, there's enough headaches and challenges that we have to deal with, then we won't do that. Also, there's also a strategic component. If you are starting a fund at early stages, your interest in leading a deal might be different than if it's a later poured over fund. Our funds are evergreen, so we don't care, but it depends on the expertise and the interest that you have.
And I think it also can depend upon the experience and the length of time the family office has been doing direct investing in the space. Since we're a new fund and the family members haven't actually decided the full complement of the assets under management that's going to be dedicated to this space, because they are diversified across all kinds of other alternative investments. We're toeing in, and as a result, we probably would not take a lead except on something that was really exceptional at this point. We would rather be part of a syndicate.
I think especially in healthcare, because it's even to take the lead from like-minded families but who are experts in specific sectors is I think is very very valuable. Because the sectors are moving, the science is moving so fast and the innovation is moving so fast that I think it's becoming more and more difficult to have let's say, a global view of where the opportunities are. And that's why we have been making very concerted efforts with assembling, friends and relationships for our family offices who have specific expertise, either operationally or from an investment side in specific sectors, in therapeutics one side, in health IT another side, etc. So, and that actually, what I think is a big advantage of that is that it continuously leads to a conversation as to how can you then essentially bring synergies between the direct investments, where I think not many funds or traditional venture or private equity funds are doing, or not enough, I would say. So.
That's all the time we got to play with today. So I want to thank everyone. I want to thank the panelists for tremendous insight into the opaque world of family offices, intentionally so. Thanks everyone, and I hope we didn't rain on everyone's parade.